Hey everyone, today we're going to talk about the 8 most important candlestick patterns in crypto trading. Crypto traders prefer candlestick charts because of how easy they are to understand and their visual appeal. As a cryptocurrency and Bitcoin trader, there are some candlestick patterns you should definitely know. Candlesticks can be traced back to Japanese rice traders. Over time, it has evolved considerably and become a vital tool for most traders. This system has been utilized and updated over the years and is now one of the best methods of charting assets. This is Josh from Phemex team. In this video, we're going to show you what a candlestick is and how to read the candlestick patterns. Before we start, please click on the like button, subscribe to our channel, turn on alerts, and share this video with your friends. Now, let's start. What is a candlestick? Today, we'll give a short introduction to candlestick and show you 8 most important candlestick patterns in crypto trading. So, a candlestick denotes an asset's price activity during a specified period. Traders can choose the periods they want to examine based on whether they're making low or high time frame decisions. Each candlestick can be set to represent any period of time, from a single minute to an entire month. Candlesticks have 4 major components: the high, low, open, and close. When trading an asset's price at the beginning of a trading period is the open, while the close shows the price at the end of the trading period. High and low, on the other hand, are the highest and lowest prices the asset achieved during the course of the trading session. So let's talk about how to read the candlestick patterns. Traders use candlestick charts to represent an asset's price evolution. Candlesticks derive their name from the long lines, wicks, and rectangular shapes they employ to denote price action within a specified time frame. With candlesticks, you can get clues and insights from the price action, as well as the general mood of the market for that asset. As time progresses, multiple candlesticks create larger patterns that crypto traders derive signals from to make vital trading decisions. At first, candlesticks may be a little difficult to understand. Still, the more one studies them, the more information these will offer when compared to simple line charts. The following image depicts how a candlestick is to be interpreted. All candlesticks come in 2 colors, green and red, though most charting services will allow customized colors. A red candlestick. A red candle shows that the closing price was below the opening price. In other words, the asset's price decreased during a specified trading period. For example, suppose the red candle depicted is a 1-minute candle. In that case, this means that the price of an asset closed below where it had opened 1 minute ago. A green candlestick. If a candle changes to green, the price of the asset increased and closed above its opening price. Wicks simply depict the difference between opening and closing prices and highest and lowest prices achieved during the specified period. For example, let's consider a green 10-minute candle that looks like the one depicted on the screen. The upper wick means that at some point during the 10 minutes, the price rose above the ultimate closing price. The difference between the highest achieved price and the closing price is represented by the upper wick. Similarly, the lower wick represents the difference between the opening price and the lowest achieved price during that 10-minute period. Important candlestick patterns you should know. There are several methods to read and use a candlestick chart. Pattern recognition is used to forecast trends, price direction, and general momentum. To understand this better, I'll show you a list of patterns you should know and how they indicate that prices will increase or how they indicate that prices will decrease. These are called bullish when they increase and bearish when they decrease. So we'll start with the bullish patterns, the ones that indicate the price will increase. First is the hammer. When it comes to appearance, the hammer is one candlestick that is very easy to recognize. The bottom of the downward trend has a long lower wick, just like a regular hammer. The body is often small, and it may have little or no upper wick. A hammer can either be green or red. Depending on the situation, it may indicate a prospective price increase or a strong reversal trend. The image on screen shows that after a period of high selling pressure, a bottom was hit. Immediately after, buyers began gaining momentum, hence the long lower wick. Once the hammer was formed, the trend was reversed and prices began to increase. That brings us to the inverted hammer. The only difference between the inverted hammer and the hammer is that the long wick is directly above the body instead of below. An inverted hammer can also be green or red. An inverted hammer signifies the potential start of an uptrend in the same way that the hammer does. Let's move on to the next one, the bullish engulfing. Two candlesticks form this pattern at the end of a downtrend. The first candlestick is red, which indicates bearish, while the second candlestick is green, bullish, and much larger than the other one. Simply put, the body of the second candlestick is large enough to fully engulf the previous candle. In addition, there should be a small gap between the opening and closing prices of both candles. In most cases, these gaps are not often seen in cryptocurrency markets. This pattern reveals that buying pressure has significantly increased and is overwhelming selling pressure. Let's look at the next, the piercing line. This candlestick pattern is formed by a long and red bearish candle followed by a long green candle. It occurs at the end of a downtrend. There is a gap between the opening and closing prices of both candles. Also, notice that the green candle is closing about halfway up the body of the bearish candle. This pattern reveals that though the start is bearish, buying pressure surges during the course of the second candle. This means that bulls have a considerable interest in buying at the prevailing price. Alright, let's look at the morning star. This pattern is formed by three separate candles at the bottom of a downtrend. The first bearish candle is quite long, while the second, known as the star, has lengthy wicks with a short body. The star candle closes below the previous candle. However, the third candle shifts bullish and closes directly above the first midpoint. This pattern shows that the downtrend pressure is decreasing and beginning to shift into an uptrend. Now, let's look at some of the bearish patterns, the patterns that indicate that the price is going down. First is the hanging man. This pattern is considered the bearish alternative of a hammer. Typically, it is created at the end of an uptrend with a long lower wick and a small body. It can be red or green. This pattern reveals that the uptrend has weakened, and traders consider it a sell signal. Next is the shooting star. This pattern is composed of one candlestick with a very small lower wick and a slim body, while the upper wick is quite long. Unlike the inverted hammer, this pattern occurs at the peak of an uptrend. This shooting star denotes a price rejection immediately after a substantial rise. The pattern is a signal of a bearish reversal. Now let's look at the bearish engulfing. The bearish engulfing is formed by two candlesticks. Just like its bullish counterpart, the first candle is green, or bullish, while the second candle is red, or bearish, and big enough to engulf the former. The body of the second candle is larger than the first. There is also a gap between the opening and closing prices of each candle. This pattern occurs at the top of an uptrend. This bearish engulfing reveals that selling pressure has increased and signifies the start of a possible downtrend. As powerful and instructive as candlestick patterns can be, please remember that it takes a lot of experience to leverage these signals with consistent success. In fact, most traders employ candlestick patterns along with other technical trading indicators for stronger validations and confirmation of trends. If you don't have a Phemex account yet, just click on the link in the description or scan the QR code on the screen. Create a Phemex account and you will get a 7-day free premium membership trial and other trading bonuses. To learn more about Phemex and cryptocurrencies, watch out the videos in the box on the left. And if you're new to the crypto world, have a look at the videos on the right for some of Phemex's user tutorials. Thanks for watching this video. Bye.